We're here on the MoneyShow.com video network with Tim Middleton talking about whether you should stick a toe in the market or whether you should just plunge right in. Hello, Tim.
Hello, Howard.
Now, Tim, you did an interesting column recently where you actually did some research and cited other research about when people should generally invest in the markets. Can you tell us what you found?
I think the bottom line is that the best time to invest is almost always today. Remember that investing is a long-term enterprise. This is money you're not going to be touching for 10 or more years. And in that context, you're not going to remember where the market was 10 years later when you bought it. And over most significant periods of our history, and certainly all 15-year periods of our history, the stock market has been positive. So I did research that I also cited some research from Dimensional Fund Advisors, and they went back further than I did. They found that in about 2/3 of the time, a lump sum investor is going to outperform someone who dollar cost averages into the market, who wades into the market. And the outperformance can be extraordinary, as much as 6 percentage points annually. And that's because of the general upward bias of markets. So the advice, I think, for the average investor is to just hold your nose and jump in. If you've gotten a lump sum, for example, an inheritance, a very large amount of money, and it just causes you too much discomfort to think about plunging in, then go ahead, wade in, maybe put in 1/4 of the money every quarter over the course of a year. But all you're going to be buying yourself there is a little peace of mind. From a performance point of view, you'll probably do better if you just put it all in today.
Now, this is quite counterintuitive, to say the least, because the conventional wisdom is certainly dollar cost averaging. It really basically eliminates a lot of the risk of trying to time the market. I mean, isn't this in a sense kind of a closet market timing?
As a matter of fact, I interviewed literally scores of financial advisors on this topic. Every one of them is an advocate of dollar cost averaging. But some of them would confess to me privately why that is so. What if they told somebody to plunge in the market on October the 1st of 2008? By October 10th, it was down, 15 or 20%?
Right.
They've just lost a client, and what's more, that person's going to tell everybody they know what a lousy advisor that is. So the person who's lowering their risk when they give you that advice is your financial advisor.
Well, let me just come back and ask you one very quick question, though. I mean, basically, can human beings handle this kind of risk? We've really seen people put to the test, and a lot of them really have kind of failed. They just pulled the money out. Isn't it better for a normal human being to just keep putting it in month after month, even if they'd get a better return over time if they just can't handle it?
If they can't handle it, you're absolutely right. My point is that if you can handle it, this is the most efficient way to invest. So you can tell yourself that you are reducing your risk if you wade in. The fact is you are not. All you're reducing is your perceived risk. If that makes you feel better, do it.
Okay. Thank you very much.
You're welcome.
We've been speaking with Tim Middleton on the MoneyShow.com video network.